We started our discussion last meeting by looking at what the main objective of a business should be. And we said that a business should maximize shareholder value. Okay, so let me just, I'm sorry about this. Okay, it's to maximize shareholder value. And we said that profit maximization or satisfying customers have their role in a company, in a business entity. However, that should not be the main objective of a business. Okay, the main objective is maximizing shareholder wealth. And what do we mean by shareholder wealth? Shareholder wealth refers to the stock price. And as an example, we said if we invested in, let's say, Jollibee shares, let's say 20 years ago, for the purposes of this discussion, let's suppose we invested in it at 30 pesos per share. And then fast forward 20 years later, the stock price is now, let's say, 250 pesos per share. That means our investment in Jollibee has grown from 30 pesos to 250 pesos over a span of, let's say, 20 years. Now, even if you put your money in the bank, it will not grow as much as that. Okay? So growing shareholder wealth should be the main objective of any business. While it is important that profit should also be the focus, and customer satisfaction should be also an objective because it leads to repeat purchases of the customers, or even the ability of the firm to cross-sell to their loyal customers. It also reduces price sensitivity, which means that in the event that prices go up, loyal customers would not immediately leave the company for other firms. And very important also is the capability of the loyal customers to be advertisers for the company, word of mouth. Okay, and we started with this, guys. We say that profit maximization is more myopic or short-term in focus, and that can be a problem. Okay, if profit maximization is more short-term, then there's a tendency to cut back, okay? To cut discretionary expenditures, because they would want to really jack up or improve the bottom line. So if you take a look at the income statement from sales down to net income after tax, the objective is to raise this up. And how is this done? If we cannot increase sales, if we cannot increase revenues, then cut back on costs that for the company might be discretionary. And examples of this are training, maintenance, research. We discussed this last time, and we said that cutting back on training would have an effect of improving the profit of the firm. So for example, if there is to be let's say, shareholders meeting in the next 2 months or in the next 3 months, and the management would want to paint a rosy picture of the business, then there's a temptation to cut back on this discretionary expenses. Okay, because it's treated as expense. And we know, guys, that this can have a long-term repercussion. Cutting back on these investments like training could have an effect on how the company runs its business, on how, for example, the employees, for example, frontliners, if they're not trained to really answer or to address customer complaints, then it might prove disastrous for the company if employees, for example, since they're not trained in order to in handling customer complaints, they might give responses that will be destructive to the what's a good term for that? That will damage the reputation of the company. Okay, so that's a problem with profit maximization. There's a tendency to cut back on these expenses like research, advertising, and even maintenance expense. Okay, another Another difference is in terms of risk management. Okay, for profit maximization, since hedging against risk might be considered as just an expense, so the firm will not quote unquote invest or do some risk mitigation activities. Let me illustrate this, guys, by an example. Okay. Now, did I discuss with you last time financial derivatives? Could you please chat in the chat box? I'm not sure if I missed discussing this here in this section or in the other section. Did we discuss that? Forwards, futures, options, swaps? No, okay, thank you. All right, so we were talking about this risk management. Now let me illustrate to you how important this is. Okay, suppose we have a firm, company A, that makes use of, let's say, commodities like oil as their raw material. Okay, so today is October 21. Okay, and there is this projection that they will be needing 1 million barrels of oil. Okay, they will be needing it by December 31, 2021. Okay, so right now the price of oil, for example, only is $50 per barrel. This is just an example, guys. Okay, so what will the company do in order to have an assured inventory of oil come December 31? Of course, they can buy the oil now at $50 per barrel. But that might mean a huge storage cost for the firm. Or the company could engage in what we call financial derivatives. Okay, what are financial derivatives? Financial derivatives, don't have to worry so much about the definition, but derivatives are assets. They're assets whose value are determined by an underlying asset. Okay, as I said, guys, you don't have to really understand everything about the definition. So the value of the asset is dependent on an underlying asset. Okay, examples of financial derivatives are forwards, futures, okay, we have options, and we have swaps. Okay, let's take a look first at these two, forwards and futures. Ano ba yung forwards and futures? Forwards and futures are just contracts or agreement between two parties. Okay, a forward is a contract between two parties where one agrees to buy a certain item at X quantity to be delivered in a future date. Okay, so we have company A agreeing with company B to deliver, let's say, the 1 million barrels of oil on December 31 at the cost of X. Okay, so that's a forward. Okay, it's a private transaction between these two companies. Okay, so what this company can do, this is company A. Company A can now contract with company B that they're going to buy 1 million barrels of oil to be delivered on December 31 at $50 per barrel. So that's a forward contract. Now, why will company A do this? Because since oil is very volatile, okay, any incident, for example, in the Middle East, or even in countries that are members of OPEC, Iran, Iraq, Saudi Arabia, okay, Venezuela, Indonesia, any incidents in these countries can dramatically affect the price of oil. So if the company does not do that, and come December 31, they will buy oil, and let's say the price has gone up to $100 per barrel, then that will be disastrous for the company because the company did not hedge themselves. So the purpose is to hedge the firm or to protect the assets of the firm. In this in this case. So of course, we're using cash to pay. So how do we now protect the company from rising prices? Cash and the raw material, which is oil. So the company needs to hedge against this, because if not, then come December 31, and if the price of oil went up to 100, then I think that will be time for the finance manager or the CFO to resign and tender its resignation, because they did not hedge the company against the fluctuation of the oil prices. So that's a forward. On the other hand, a futures, guys, is just like a forward, but it's conducted in a market. Okay, so let's see. If I type here Chicago Board of Trade. Okay, Chicago Board of Trade, guys, is a market where companies buy and sell commodities, for example. So if I click this, okay, let's open this CBOT, Chicago Board of Trade. It's a world's leading and most diverse derivatives market. Okay, so take note. Derivatives market made up of 4 exchanges. So there are 4 markets here: CME, CBOT, NYMEX, and COMEX. Okay, so what are the items that are traded here? Okay, let's see. Markets. If you can see, can you see this one, guys? So there's agriculture, energy, foreign exchange, interest rates, metals. There are options. There are cryptocurrencies. Okay, these are items: gold, copper, all products, oil, soybean, corn. These are items or commodities that are traded in this market. Okay, so this is what we call a futures market. It's not a forwards market, because in a forwards market, there are 2 private entities that transact. Here, you go to the market itself, the CBOT, and it's the CBOT that arranges the transactions. So if I buy, for example, agriculture to be delivered at a certain point in time, okay, whether it's wheat, soybeans, okay, excuse me, guys. Sorry about that. Okay, so this is a futures market, as I was saying. In the futures market, buyers and sellers meet to buy different commodities, the one that I showed you, metals, agricultural products, livestock, etc. And what's the purpose of this? The purpose of this is for hedging, in order for the company to transact their business now for delivery in the future. Because if the company believes that the price of oil or whatever commodity will increase over time, then they're able now to hedge. Okay, so for example, if let's go back to our example. Okay, so company A went to the futures market and bought 1 billion barrels of oil to be delivered on December 31. So one good thing here is that they will not have to accept the 1 million barrels of oil yet. If the delivery is on December 31, okay, and then if the price, so fast forward December 31. Okay. If on December 31, let's say December 31. Okay, so there will be delivery of 1 million barrels of oil, and the purchase price is $50 per barrel. If on December 31, okay, if we take a look at the spot market, okay, what's a spot market? The spot market is the current price. It's a market where you can buy oil at that specific time. Okay, if the spot price of oil at that time was, let's say, $80 per barrel, then well and good, because the company is able to buy oil at $50 per barrel on December 31 delivery, when on that time oil is now selling at $80 per barrel. So finance would be commended for that, because they were able to hedge the company a big savings. Because if they had bought the item on December 31 itself, then that would have been $80 already. Okay, so that's good. So that they were engaging in a futures market. But what happens if the price of oil, let's say something went down, something happened? For example, there was a discovery of a new oil field in the Pacific, for example, and because of this, the inventory of oil went up. It shoot up. So the price of oil went down, let's say, to $28 per barrel. Spot market, December 31. So what happened now? The company lost money because they transacted per barrel at $50, but now spot market, December 31, it was now selling at $28 per barrel. And this happened, guys, in the past, many times in the past. So the futures, guys, can go either way. It can be very good for the company, or it can be very bad. So that's the danger also of the futures. Unless the company is really very certain that really this commodity will go up. For example, there are certain commodities that really the prices do not never really go down. So in that case, then it's okay to engage in the futures market. But there's one other derivative that the company can engage in, and it's called options. So in options, the objective is to buy the option. So it's not buying the commodity itself. It's buying the option to buy the commodity. Okay, so what happens here? So I go to the CBOT, for example, and I go to the options market, and I buy the option to buy 1 billion barrels of oil, 1 million barrels of oil at $50, delivery on December 31, 2021. Okay, I'm not really buying the commodity per se. I'm just buying the option, the right to buy it. Okay, so of course the payment will be just the option price. Okay, and this is of course much lower than the cost of the item itself. So fast forward December 31. Okay, at that time, December 31, the price of oil became 80 per barrel. So may I have your response, guys, please? If the price of oil became 80, and I have here an option, a contract, an option to buy it at 50, please chat. Will I exercise the option or not? Yes or no? Will I exercise the option? Should company A exercise the option? Very good. Thank you so much, guys. You're correct. Yes, of course. Exercise the option. Okay. Exercise the option kasi you have the right. You have the let's say the word is option to buy oil at $50 per barrel, because back in October 21, you went to the options market and bought the option to buy $1 billion of 1 billion barrels of oil at $50 per barrel. Fast forward December 31, the spot price of oil was 80. So you exercise the option. If on the other hand, the spot price was $28 per barrel, should you exercise the option? Yes or no, please? Should you exercise the option if the spot price of oil was 28? Okay, correct, guys. Thank you. No. No. Did you lose something? Are you going to lose something? Yes. What did you lose? Just the option price. Okay. Diba? Oh, you only lost the option price, and it's far less than the cost of the item itself. Okay, so this is a very good derivative, guys, in order to hedge the company against the fluctuation of prices, etc., to protect the assets of the firm. And in profit maximization, guys, there's a tendency not to consider the risks, the organization's risk profile, versus wealth maximization, where risk and return is of primordial interest. Okay, so that's as far as risk management is concerned. Now let's take a look this time at, okay, I'll pause for a while. Is that clear so far, guys? Thank you for your responses. You're correct in your responses. Okay, so there's a difference in as far as wealth maximization and profit maximization is concerned in terms of planning duration. Okay, in terms of planning duration, in terms of risk management. Also, there's a difference in terms of pricing strategy. Okay, what's the difference, guys? What's the difference between profit maximization and wealth maximization? Profit maximization and wealth maximization. If the focus is on profit maximization, then there's a tendency for the company to really price their product as high as possible. Okay, because the objective is to increase the net income after tax. So we know the net income after tax can be improved by looking at the sales itself or looking at the cost items itself, costs. Okay, so either you jack up your sales or you cut back on your costs. Okay, there's nothing wrong, of course, guys, with the increasing sales. Of course, that's very important. There's also nothing wrong with the reduction of cost, but there's a big caveat there, guys. There should be a qualifier for that. In wealth maximization, a company is willing to do the reverse. The company is willing to reduce prices. Okay, so it's more of a come on in order to build market share. Because if you're taking a look at market share rather than profitability, you're taking a look at building a long-term sustainable business. Okay, so that's a difference, guys. So profit maximization, kasi short-term yung tingin, no? We look at the short-term. So we would want to, as much as possible, jack up the prices at the altar, at the expense of getting more market share. Okay, or reducing costs again at the expense of long-term effects. Okay, is there a question here? Can you clarify again the difference? Okay, Charmaine. Okay, let me clarify that. Charmaine, can you share your question to the class? Charmaine, could you kindly share your question to the class? Yeah, okay, thank you. Clarification between the difference between forwards and futures. Okay, let me go back, guys, to our example. Okay, so these are the four major types of derivatives, okay? Forwards, futures, options, and swaps. A forward, guys, is a private transaction. It's a private contract between the two companies. For example, our company is company A, and let's say we transact a business with B. We're going to buy oil, this 1 million barrels of oil to be delivered on December 31, 2021 at $50 per barrel. Okay, that's a forward contract because we're contracting with, let's say, Petron, okay, A and B. On the other hand, a futures, in the futures market, you go to a futures market. Okay, so you don't actually know who the seller is. It's the futures market. It's a market that will arrange the transaction for us. Like in the, for example, in the stock market, when you go to the stock market, you have to go through a broker or a brokerage company because only brokers are allowed to transact business through the stock market. So you say you'll order 1,000 shares of Globe Telecoms. Okay, so your broker transacts the deal for you. There are sellers now. There will be sellers of Globe Telecom, and you would want 1,000 shares of that. So the broker will be the one to transact the business. So that's the market. Okay, you don't know who the seller of the Globe stock 1,000 stocks is. Okay, it's the broker who does that for you. That's the futures. That's the stock market. Okay, so you go to the Philippine Stock Exchange to transact the business. Okay, that just like the futures. If you buy oil, for example, you go to the futures market. There are brokers that will do that for you. Okay, you don't know who really is selling that oil that you're going to buy. In the forwards market, you know who you're buying to, and the seller knows who is buying from them. Okay, Charmaine, is that clear? Okay, thank you, Charmaine. Thank you for that question. Really appreciate questions like this. Okay, then last, guys, difference between wealth maximization and profit maximization is in capacity planning. So what's the difference between them? As we mentioned, guys, for profit maximization, the objective is really short-term in that sense, so that the company might forego building capacity. because they just need enough productive capacity to handle sales for the next few months, okay, for a short-term sales forecast. For wealth maximization, it's really more on heavily really developing capacity more for the long-term sales projections. So they will be investing, for example, the forecast is that in 5 years' time, in 3 years' time, market will be doubling. So how can we tap that market in the near future, in 3 years' time, 4 years' time? So the company might decide to invest in more equipment, invest in the latest technology so that they'll be able to produce more. Okay, so that's very important as far as wealth maximization is concerned. Okay, let me again address this. Let me discuss this in further detail. Okay, so how does now a company, build up its capacity? Okay, usually they would engage in what we call capital budgeting. When you say capital budgeting, okay, the objective is to invest in CapEx or capital expenditures. This is different from what we call OpEx. OpEx, guys, is operating expenditures versus capital expenditures. When we talk of OpEx, we're just taking a look at the expenses for the current operating period, for the current year, for example. So OpEx involve, for example, transportation expense, supplies expense. These are the normal operating expenditures. When we talk of CapEx, we talk of long-term investments. So for example, the company would want to invest in a machine and in a new technology, for example. And when we talk of capital budgeting, there are usually two types. Number one, it's mutually exclusive projects or independent projects. So these are the two types of the projects, mutually exclusive and independent. Okay, what's the difference between the two? When we talk of mutually exclusive projects, so let's suppose we have project A, project B, project Z, C, and D. And the company would want, let's say this is a software, and the company would want to invest in these different softwares, okay, and they're expensive softwares because they're capital budgeting, okay, and they will benefit not only the current period, but future periods. When we say mutually exclusive, it means that the choice of one will exclude the others. So if the company decides to choose A, that means they will no longer invest in B, C, D. So for example, they're going to invest in a database management, okay, to manage their data warehouse. Okay, so if they choose software A, then that means they don't need B, C, D. That's what we mean by mutually exclusive. So let's suppose that they computed the returns. The returns based on software A will be, let's say, 15%. CB, let's say 14.8%. CC will be 14.5%. CD will be 13.2%. So this is what we call the return, or we call it the IRR. Okay, the IRR, internal rate of return. Okay, so which of the projects here should be chosen by the company? Okay, let me write that. Internal rate of return. Which among these softwares should be chosen by the company? A, B, C, or D? Could you kindly chat, guys? Please write your answer in the chat box. Okay, correct. Okay, A, of course, because it gives us the highest internal rate of return. Okay, let me go back to this, guys. Mutually exclusive. I'll define first what independent projects are. On the other hand, guys, if the projects are independent, let's say A, B, C, D, if they are independent, then the choice of A does not necessarily exclude B, C, D. Okay, so for example, a company would want to have branches in Mindanao and Visayas. So they might choose a branch in, let's say, Cagayan de Oro, CDO, or Davao, or Cebu, okay, or Zamboanga City. Okay, so these are the options that they have. So they will study finance, and the other departments will have a study of this and determine which of the branches is most feasible. Let's suppose the cost here is let's say 1 million. The cost here is 1.2 million. This is 0.8 million. Okay. So this should be more expensive. Let's say 1.8 million, and this is 0.9 million, for example. Okay, if all the projects are feasible, then should the company choose them? Yes, the answer is yes, because these are independent projects. Unlike mutually exclusive, when you have to choose only one. Now, what will be the constraint here might be the budget. So for example, the company has only 2.5 million as budget. Then that means, because everything here, 1.2, 3, 4, this is 4.9 million. That means the company will not be able to really invest in everything. So they will just choose the best, and that will cover their, that will cover the cost, their budget. Okay, so that's what we mean by independent projects. Now going back here, guys, to mutually exclusive. So we were saying that we choose project A because project A has the highest internal rate of return. Okay, you're correct. However, guys, that's just half of the story. We don't just look at this IRR. We have to compute what we call, this is very important, guys, the weighted average cost of capital. Okay, what's the weighted average cost of capital? Let me write that, weighted average cost of capital. So what's this? What's this WACC? Well, we know, guys, that a company needs funds to finance its projects. And the funding is not free. Two sources of financing are the shareholders and the creditors. So the funds being provided by these entities are not free. In other words, these entities, the shareholders and the creditors, expect something in return. In that case, guys, there is a cost to financing. Okay? Hindi free, guys, yung the contribution of shareholders. The contribution of creditors is also not free. There's a cost to that. So the company should compute for the average cost of capital. This is the average cost of acquiring capital from the shareholders and the creditors. Now, the formula for that, let me just quickly show you the formula. Okay, we're going to learn how to compute this towards the end of the term. Okay, it's just a summation of there. It's wiki, the summation of wiki, where W is the weight and K is the cost of the capital. So this is, if we expound this, this will be the weight of the debt times the cost of the debt, and there's this factor 1 minus tax rate, okay, plus the weight of the common stock times the cost of the common stock, plus if there's preferred stock, the weight of the preferred stock times the cost of the preferred stock. Okay, that's how the weighted average cost of capital is computed. Now, it's very important for the firm to know how to compute this. Okay, it's very important for the firm to know how to compute this. And the weight is very easy. Okay, so for example, okay, let's suppose the debt in the company's balance sheet, the debt is 10, the common stock, let's say, is 20, and the preferred stock is 5, for example. Just an example. The total is 35. Now, the weight is simply computed by, for the debt, it will be, weight of debt will simply be 10 out of 35. So that's very easy. Weight of the common stock will simply be 20 out of 35. So it's just a ratio between the contribution of the financing over the total. And then weight of the preferred stock, which is 5/35. So the W's are very easily computed. What's more challenging is the cost, this one. Okay, the case, okay? And notice, guys, in the weighted average cost of capital, the debt component has this 1 minus tax rate. Okay, so let me just briefly explain, and then I'll go back to this later on. If the tax rate was 30%, for example, so what happens to the cost of debt? The cost of debt is reduced by the amount of the tax rate. So it will be the weight of the debt times the cost of debt times only 70% will be taken from the cost of the debt. Now, there's a reason why. I'll explain that later on. There's a reason why the cost of the debt is netted by the tax rate. Okay. However, the cost of the common stock and the cost of the preferred stock is not netted against the tax rate. Okay. So let's suppose, guys, that upon the computation of WACC, it turns out that the WACC is, let's say, 18%. So could you kindly chat, guys? Yes or no? Should we proceed with project A? Yes or no? Chat, please. I want a yes or no answer from you. The internal rate of return of project A is 15%. The WACC of the company is 18%. Should the company push through with the project to invest in software A? Can we chat, please? Yes or no? Okay, so Charmaine, was this your answer, Charmaine? Okay. How about the rest, guys? I'd like to see the answer of the others. Only one answer. Okay, Lorenzo, thank you. Thank you. How about the others? Ulitin ko yung question ko, ah. Okay, thank you, Joshua. The weighted average cost of capital is 18%. The return of project A is 15%. We're going to use chapter A because it has the highest internal rate of return. So should we push through with the investment in A? Okay, all right. Okay, I've seen around 6 answers. Okay, the answer is correct. It's no. Bakit no, guys? Because the return of the project is only 15%, while the cost of acquiring funds is 18%. That doesn't make sense. We're going to borrow, let's say, the average cost of getting funds is 18%. And then, so we're going to pay on the average, we're going to pay the financiers 18. And then we're going to get only a return of 15%. Does that make sense? No. So what's the decision rule? If the return, if the IRR, okay, if IRR is greater than WACC, okay, accept the project. On the other hand, if IRR is less than WACC, then this is reject the project. Okay, so the IRR is very important. There's another measure, guys, which is used aside from IRR. It's called the NPV. This is called the net present value. We're going to learn how to compute this later on. Suffice it to say, guys, that if the net present value is greater than 0, then the project is okay. And usually the NPV and the IRR agree with each other. Okay, they have the same feedback as far as accepting the project or not. There are cases where they disagree, but we'll discuss that in greater detail later on. Okay, let me pause for a while as far as this this investment is concerned. Any questions about this, guys? Okay, so please chat yes if clear so far. Okay, thank you, Tracy. Paki-chat na lang, guys, ng yes if our discussion is clear so far. I'm going to save this and I'm going to send this slide, these PowerPoint slides to you. Okay, thank you. Okay, thank you. Although, guys, again, I'm seeing only a few answers. I would wish that, okay, I would wish that almost 100% of us will respond. Okay, thank you. Thank you so much. I appreciate your responses. Okay, so let me go back here. Capacity planning. Actually, guys, this discussion, okay, I went ahead of myself actually. This is more here. Okay, but I'll show that in a while. Okay, now very quickly, guys, have you heard of the triple bottom line? Ever heard of the triple bottom line? No, some of you yes, some of you no. Okay, no, yes. Okay, it's a mixed answer. Okay, okay. So let me explain for a while what the triple bottom line is, because so far we said that the objective of the business should be maximizing shareholder value. So it's called shareholder value maximization, or maximizing shareholder value. Now there are some that disagree with this, and they say that it should not be maximizing shareholder value alone, but maximizing stakeholder value. So this is called stakeholder value maximization. Now what's the difference? When we talk of stakeholder, we're saying that there are other parties that are interested in the well-being of the organization. So the firm should also maximize the objective should be maximizing not only shareholder value, but also the other stakeholders. And that's where the triple bottom line comes into play. Okay, let's take a look first at the firm. Could you identify, guys, what parties are interested in the well-being of the firm? When I say well-being of the firm, these parties would want the firm to succeed. Could you identify? Please unmute yourselves, please. Okay, what parties are looking at the firm and they would want the firm to succeed? Can you identify, please? Examples of parties that would want to see the firm. Okay, Harold, can you unmute yourself, please? Investors, specifically, investor, because we have, say, for investors, there are two major types. We have this and we have this. Okay, Harold, which investor are you thinking of? We mentioned this already. Yes.
Specific investor, pero ang alam ko lang po investor.
Okay. Sige. Thank you, Harold. But we know that they're shareholders, di ba? Yung mga nagdadala ng pera sa firm, shareholders and creditors. We already did mention this. No? The two investors, main investors, are shareholders and creditors. Now, okay, let's write both of them here. Shareholders. Oops, something's wrong with my digital pen. Shareholders and creditors. Okay. Why do shareholders invest in a firm? What's their motivation? Why do creditors invest in a firm? Ito yung main motivation nila, no? Okay, so what are these guys? Creditors invest in a firm because of what? Anyone, guys? May I request you to unmute na lang or raise your hands, guys? It's okay, Harold, thank you. But Harold, thank you for answering, okay? No problem. Okay, so anyone, please? What's the motivation among creditors and among shareholders? For creditors, two things. What do they stand to get by lending a firm? Free ba yun? Do they render their services? Do they lend huge amounts to a firm because it's free? Nelson, Renzo, kindly please, can you raise your hands and unmute yourselves? Kasi para, kasi if I have to keep on opening the chat box, guys. Yes, James, please.
For shareholders, sir, they want to invest so that they hope to receive a portion of the profit so that
Okay.
in comparison to their shareholdings.
Okay. Or what? How do you call this profit?
I'm not too sure, sir.
Letter D. Dito, no? It's here.
I can answer, sir.
Okay. Okay. Sige. Who would like to volunteer, guys? Thank you, James.
Me, sir.
Who's this?
Renzo Cruz po.
Renzo, yes.
Yes. Dividends, sir.
Yes, okay. Dividend siya, no? Shareholders will get, if the company issues dividends, then they'll get this. Dividends. Aside from dividends, what else? What's their motivation for investing in the company? Can be more important than dividends.
Capital, sir.
Yes, okay. We call it capital gains or capital appreciation. Capital gains or capital appreciation. So what do we mean by capital appreciation? Okay, just like the example we had about Jollibee. If we bought the Jollibee per share 50 pesos, 30 pesos, and it's now 250, that means the capital investment that we had there already increased. It already appreciated. Okay, by that amount from 50 or 30 to 250. Okay, that's what we mean by the motivation of shareholders in investing in a particular firm. And firms that provide dividends and where investors enjoy capital gains, okay, investors would like to invest in companies like that because they know that the company has the capability to generate future cash flows. Okay, so it's all about cash flows, guys. Dividends, guys, require cash flows, excess cash flows from the firm. So a company that has excess cash flows, they have the capability to distribute dividends among the shareholders. Okay, so shareholders are in fact very keen in the well-being of the organization. Not only shareholders, also creditors, because they tend to get what? Okay, you call this interest, guys, right? Interest payments. Okay, if a creditor, for example, let's say Ayala Corporation borrows from, let's say from, okay, BPI, okay, or let's say San Miguel na lang, San Miguel Corporation borrows from BPI 100 million at let's say 8% interest payable in 10 years. Okay, so San Miguel Corporation will be paying 8% of the 10 million annually. Okay, so that's 8 million. 8 million per year. Okay, of course, usually monthly yan. Tapos 10 years, guys. At the end of 10 years, ano tong P na to? What do you call this? This
Proceeds, sir.
Proceeds or your principal. No? Principal. Okay, the return of the principal, yung 100 million. This is called principal. Okay, so BPI expects San Miguel to pay back that 100 million that was borrowed at the end of the maturity of the loan or after 10 years. Okay, so both investors, shareholders, and creditors would like to see the firm succeed. Because if the firm does not succeed, then the firm might not be able to render or pay its debt or pay its interest. Okay, but aside from these two parties, who else? Which other parties are interested in the well-being of the organization? Anyone? Kindly share. Just unmute yourself. Introduce your name and then unmute yourself. Sino pa, guys? Which other parties are interested in the well-being of the organization?
Sir,
Yes.
Charmaine po.
Charmaine, yes.
The employees po.
Yes, thank you, Charmaine. Of course. Bakit kaya, Charmaine? Why? Why do you think so?
Sir, kasi kung maganda po yung kita ng company, malaki din po yung kita ng employees po.
Yes, of course. Employees, managers, they are the internal customers of the company. Okay? If the company is doing well, then it will have the capability to provide more benefits to the employees, right? Or to sustain their living. We know that employees usually, either the mother, the father, or the siblings, when they're employed, they tend to support also the other members of the family. So at stake, yung living, yung condition of living of the ones who are employed by the firm. And if firm becomes bankrupt, then the employees loses employment. And that can spell really, really great difficulty for their families. Okay. So thank you, Charmaine. You are correct. Employees, managers, who else, guys? Let's identify some more. Some more, please. Anyone? Shareholders, creditors, employees, managers. Who are the other parties that are interested in the well-being of the organization? Yes, Charmaine again. Yes, please.
Or the business owner po.
They're the shareholders, no? The business
Okay.
owners are the shareholders. Thank you, Charmaine. Okay, who else? Any other volunteer guys? How about this, guys? The G. Of course, they're interested in the well-being of the organization. Who are these guys? The S. Okay, even the C. Even the C. There are a lot of parties that are interested in the well-being of the organization. Who do you think this is, guys? Yes, Kyla?
Sa C po, consumers also.
Yeah, okay. Consumers or customers? Yes, of course. Diba? Why are customers interested in the well-being of the firm, Kyla?
Kasi po they're the ones who parang invest their money to the firm. Tapos they expect the firm to give them the quality.
Okay, thank you. Thank you, Kyla. They're actually not investors, okay? Technically, they're not investors. They patronize the services or product produced by the firm, okay? That's what they patronize, but they're not really, technically, they're not investors, okay? So customers would want the firm to perform well, to be good, because they depend on the output of the firm. If you recall, maybe 3 years ago, 4 years ago, there was a scandal in China where there were infant milk producers that used, I think, melamine as an ingredient which could harm their babies or their infants. So that became a scare for many of the consumers. Consumers would want the firm to really produce good quality products, because at stake could be their health, especially if they're taking in food or medicine. Okay, so customers are really keen on the success of the firm because they want the firm to produce good quality products. Yeah, Kyla, that's true. Okay, so others, guys, customers, who else? Yes, Renzo?
Sir, I'll try lang po for
Yeah,
G
sure.
and S.
Yes, okay.
Government entities
Okay.
and suppliers.
Yes, you got it both, no? Thank you. Thank you, Renzo. Government and suppliers. Renzo, why the government?
Firms being one of the major taxpayers po of the country.
Mhm.
Like, the government could really benefit from it if like the firms are, like the more profit they have, like
Yes.
the more tax that
Yes,
that
exactly.
government can receive from them po.
Thank you so much, Renzo. That's perfect. No? Tax. Okay. Of course, the government needs to collect money because they're providing services, whether it's infrastructure, social services. Where will the government get money for their DSWD projects? Yung cash benefit program for the marginalized poor. If businesses flounder, if businesses become bankrupt, how will now the government raise money? If businesses become bankrupt, therefore employees will not have employment, they will not have work. And one of the greatest amount of tax which government collects is income tax, especially from employees. Okay? If businesses collapse, there will be no employment, no work for employees, no tax collected, okay, and that will be disastrous for the government. Okay, so firms play a very critical role. The wellness of the firms So that's why government is really very keen on promoting a robust, healthy business environment, because at stake is also their survival. Okay, and Rancho, thank you for bringing out suppliers. Let me just quickly discuss with you. This is very important. Okay, the supplier side. Okay, let me insert another slide here. Let's talk about suppliers. Now, I'd like to tell you a story where there's a difference between the Western philosophy of doing business. Okay, they do what we call the push system, versus some company in Asia where they do the pull system. Okay, anong difference ng push system? Where in terms of suppliers, okay, in the push system, companies would just let the suppliers fight it out with each other. Kaya nga may bidding process, whoever the best supplier is wins. Okay, so they let the suppliers kill each other. So that's what we call the push system. Unlike the pull system, where this company was able to partner with some suppliers, and it was a symbiotic relationship. Okay, so this was more of a partnership type. Okay, this is what we call the pull system, where they help each other out. So the success of the company really is dependent also on the success of the suppliers, and vice versa. Okay, that's why in this system, what was in practice was JIC, while here what was in practice was JIT. Okay, what's JIT? JIC. This is just in case. Okay, what's just in case? In this system, companies would invest in a very huge warehouse. Ang laka-laka ng mga warehouse, and then they would buy so many raw materials. They would store it there. Okay, they would store it there. Okay, so that when there's a need for this raw material, for example, it will be readily available and brought to the warehouse for manufacturing. Okay, this is good, guys. This is good. However, guys, this is very costly. Yan, billions yan. Okay, because you have to invest in a huge warehouse. You have to invest in huge inventory, and there's what we call inventory cost. Okay, inventory cost. There are storage costs, handling cost, okay, delivery cost, okay, ordering cost. A lot of costs that come with inventory. And because of this philosophy, just in case, what happens to the pricing? It has to go up, because the price of the goods now has to incorporate the cost of warehousing, the cost of this inventory cost. Okay, unlike this one, guys. In this system, the just in time, this company was able to do away with this. It does not need this big warehouse, because it was able to encourage the suppliers to relocate near them, so that if it needs, for example, X number of raw material A, for example, raw material A, it will just tell this supplier A, okay, to deliver, let's say, 100,000 pieces. And since it was located near the company, no problem. That's why it's called just in time. Just in time for delivering these 100 pieces of raw material. Okay. Actually, this was born out of what we call TQM. Anyone knows what TQM stands for? Anyone knows? Okay. Thank you, Lorenzo. Okay. Customers, yes. TQM, guys, stands for total quality of, sorry. Mikhail, did you, sorry. Mikhail, did you?
Okay na po.
Okay na? Sige. What were you trying to say, Mikhail?
Sir, the meaning of TQM po.
Yes, what is it?
Sir, it consists of organization-wide efforts to install and make permanent climate where employees can continuously improve their ability
Yes,
and
correct.
demand the products and services po.
What does TQM stand for? It's total quality management. Okay, so Mikhail mentioned something about continuous improvement, and that's called your Kaizen. Kaizen sounds Japanese, guys, no? Kaizen means continuous improvement. So when you compare the products of these Western companies, and this company, you'll notice that in terms of defects, no? Ito, after a finished product, here, there could be more than hundreds of defects. Dito, almost none, almost zero. This is a whole family of operations concept or manufacturing concepts. Would you know which company is this, guys, that popularized this just-in-time philosophy? It starts with the letter T. And I'm sure you know this, you have experience using this most probably. You've experienced using this product. Any guess, guys? Clue, guys. Kaizen is a Japanese word. It means constant change. So what do you think is this company? There's a book written about this company. It's the machine that changed the world. It changed the world of operations of how business is done. JIT versus JIC. Okay, anyone, please? Letter T. Okay, clue. In the US, these companies like Ford, okay, Chrysler, okay, they practice this JIC. Who's this? Okay, unmute yourself, please.
Sir, is it Toyota?
Yes, this is Charmaine.
Yes, sir.
Okay, yes, Charmaine, you're correct. This is Toyota, guys. It's interesting to study the history of Toyota, and its links with total quality management. Nowadays, guys, sa US, pina-practice na rin to. This JIT. Okay, so this is Toyota. Okay, so it revolutionized the way the relationship with suppliers. Okay, so we said that suppliers are very important. They're keen in looking at the well-being of the organization. Okay, so let's identify some more. Okay, in the interest of time, guys, I'll just identify them. How about let's see. How about competitors? Do you think competitors are interested in the well-being of the firm also? Okay, we might be tempted to say, no, the competitors would want the firm to fail. On the contrary, guys, that might not be true. Now, there's this author by the name of Michael Porter. Michael Porter wrote this book, very popular book, Competitive Strategy in the 1970s. He's from Harvard, and he mentions that there are what we call good competitors and bad competitors. Okay, the example I gave you a while ago, yung bad competitors, there exists such in the infant milk. Okay, so what happened was those that are producing good, safe products were affected because there were some bad apples in the industry who would cut corners and would use some ingredients that were harmful to the infant. So it affected the whole industry. However, there is what we call good competition. And this good competition exists because these companies rub on each other. For example, sa atin, si Globe at saka si PLDT or si Smart, and now Tito. Okay, you might think that Globe would want to PLDT or Smart to collapse. Not necessarily. Not necessarily. Because competition really helps the players in the industry. It makes them be more efficient. It helps them be more on their toes. It helps them not to be very complacent with their services, because they know that if they become such, then their competitor might eat them alive. Okay, so competition is good not only for the firm. In fact, it's also good for consumers, right? So there's such a thing as good competition, and there's such a thing as bad competition. And I'm referring to good competition. Good competition, good competitors would like to see also the firm succeed to a certain degree. Okay, and also there's another C which we could mention, and this C is, of course, guys, the community. Diba? The community would want to see the organization succeed. Of course, the community stands to benefit from the firm by virtue of their CSR projects, for example, their corporate social governance projects, or they would stand to benefit from employment. Some companies would make it a policy that, let's say, 60% of their labor force and their factory should come from the community, the surrounding area. So the community stands to benefit. So given this, all of this, we call them stakeholders that are interested also, that have a stake in the firm, shouldn't we use instead that it should be maximization of stakeholder value vis-a-vis maximization of shareholder value? Now, for me, guys, if you ask my opinion, I will have you read some articles about this, the debate between this. Personally, for me, okay, stakeholder value is very good. However, it might be very good only in paper. For implementation, it might be very difficult, guys, because we know that a firm has limitations. How can now a firm really cover so much trying to maximize their objectives by looking at all these parties? And sometimes there might be some conflict between the interests of the parties. Creditors, for example, might want the company not so much to invest money to produce quality products, because they want the company to make sure that they're able to pay the interest payments. And the customers might not want that. That might be a very exaggerated example, but that can happen. There could be conflicting interest among the stakeholders. Okay, so it might be very difficult for a company to really look at all of this and focus on each with equality, with equal focus. Okay, so for me, it's still maximization of shareholder value, but that's only my opinion. Okay, and I'm sure there are others who will not agree with me on this, but I will leave you guys to form your opinion on this by asking you to read some very important articles about this. Okay, so that's where we have this triple bottom line, the 3 P's or the 3 E's. What's the 3P, guys? 3P, if you take a look at this as a pyramid, it's a triangle, you have 3 P's means the profit. So profit is important, but not only profit, a firm should also look at, okay, what happened? Also the planet, okay? And the people. So that's your 3 P's. Or for the E, this is your economy, ecology or environment, ecology, and your employees. So this is related to the stakeholder value maximization, okay, which says that the company should not only be focusing on shareholder value maximization. Besides, guys, if the company is able to really focus on shareholder value maximization, then the others will follow. For me, the others will follow. For me, the primordial, the very prime focus should be on shareholder value maximization. But of course, guys, you might have a different opinion, of course. I've known of other teachers who believe it's stakeholder value maximization. That's okay, guys. Okay, so very briefly, guys, let's I'm running out of time. I want us to at least be at par with the other sections. When we talk of finance, there are several divisions, there are several definitions. One of them comes from Investor World, which says that finance has its roots in economics. Economics is all about scarcity of resources and allocation of resources. So that's true with finance. In finance, we talk about scarcity of resources. So there's a need to allocate these resources properly, manage these resources, acquire the needed resources, and manage them properly. So it's all about, so recourse acquisition, of course, needs money. Okay, so it's all about matters related to money. Again, this word money. So I said before, I said in our first meeting that one of the fundamental principles of finance is cash is king. Cash is very important. Okay. Another definition by Gitman is that I introduced this last time. It's all about looking at the institutions, the markets, the instruments, the processes that has something to do with the transfer of cash among these parties. So we take a look at the flow of funds, flow of cash among these parties. And for Kion, it's all about finance is all about maintaining and creating economic value or wealth, otherwise known as shareholder wealth. So we notice that finance deals with these fundamental points, and you notice that there's no profit statement here. It's all about creating value, shareholder value. It's all about money, cash flow. Okay, so financial management, guys. Okay, so saan ba to yung kanina to, no? Okay, so when we talk of, there are several branches of finance. You have in personal finance, you have government finance. The focus of this subject is corporate finance. And when we talk about corporate finance, what is it? Others think that it's an extension of accounting. That's not true, because accounting is more backward looking, while finance is forward looking. The main goal of the accounting process is to generate financial statements. So it's recording what transpired, what happened, and then generating the summary in the form of financial statements. Corporate finance, yes, it involves financial modeling, but it's not really totally financial modeling. And some say that corporate finance is all about banking. Banking is an important aspect of finance, but it's not necessarily the whole corporate finance. Okay, so there are three important activities. Okay, so finance deals with anything with the use of money, and finance, where money is involved, finance will have its hands on it. Okay, so when we look at an organization, okay, so we say here that broadly, everything that a business does that involve money is under the microscope of finance. So marketing, for example, in the as far as pricing is concerned, finance should have a say on that. Acquiring accounting systems, information systems, finance should also have a say on that. Any investment in human capital, whether it be a human resource information system, finance should have a say on that. Corporate strategy, guys, what do you mean by corporate strategy? Let me give an example. For example, Ayala Corporation is a mother company. Then under it are what we call SBUs. SBU, which means Strategic Business Unit. Okay, what are the strategic business unit as far as Ayala is concerned? Whoops. Where are we? Okay, for example, BPI, you have Globe, of course. So several SBUs here. Okay. As far as corporate strategy is concerned, when you say it's corporate strategy, we talk of in which industries, in which businesses should the company be involved in. This is the mother company, Ayala Corporation. If, for example, Ayala Corporation decides, let's see, I don't know if they have investment in natural gas. If they decide to do that, it will have the say-so of finance. Okay, finance will play a major role there in determining whether it's feasible to invest in natural gas as another industry, because the mother company decides to place its resources in several industries, just like Ayala Corporation, just like Rubina, okay, URC, just like San Miguel. Okay, they have several SBUs because the principle is that they do not want to put their money in one basket. Or operations, guys. So this, you can see the hand of finance in all these aspects. So financial management is very important. And there are three activities, three principles that finance doubles into. Okay, so I think I have about 2 more minutes. Number one is investment principle, financing principle, and dividend principle. Okay, so for the investment principle, the question is, should the company invest in this project? Now, we already discussed this a while ago when we talk about WACC. Okay, so we say here, decide what projects, whether it be mutually exclusive or independent projects, which acquisitions to invest in. And the decision rule is that earn the highest possible risk-adjusted return. So what do we see here? It means the highest IRR, and the IRR that's greater than the WACC, because it should be risk-adjusted. Okay, risk-adjusted means you take into consideration IRR. Okay, and then you have this capital financing, okay, and then dividend distribution. Okay, so it's already time. Okay, I'm going to stop here, guys. I'm going to stop here. So next meeting, we will quickly go through this. We already discussed investment principle. It's this one, guys. This has something to do with the investment principle, so I'll put it here. Okay. And then, so next meeting, we'll look at financing principle and dividend principle and move on from there. Okay, so with that, guys, I'll stop recording. Okay, thank you very much for listening.